Hi, I'm Mark Neuman, founder and CIO of Constrained Capital. Welcome to episode 2 of the story of the ESG Orphans, Truth in ESG. We're going to talk all things ESG with Professor Aswath Damodaran when we return. Stay tuned. Hello, everybody. Welcome back. Have you wondered why ESG is in the news every day? It's starting to get a lot of airplay as the problems in ESG are coming to the surface. If you've wondered those things, you're in for a treat today because we are bringing the esteemed NYU professor, the Dean of Valuation, Professor Aswath Damodaran, onto the stage to talk to us today about ESG. Welcome, Professor Damodaran.
Thank you for having me.
Yeah, really looking forward to having him here. I want to remind everyone that sort of the background of getting to where we are now as ESG orphans, it started with hedge fund legend Cliff Asness's piece called Virtue is Its Own Reward. He talked about virtuous investing and fin stocks, and his conclusion was the ancillary consequence of ESG investing is lower returns. He talked about capital constraints and higher returns on stocks that are excluded. When I did a lot of my research, I came across Professor Aswath Damodaran's piece entitled Sounding Good versus Doing Good, a Skeptical Look at ESG. So we are very fortunate to have the professor here today to talk to us a little bit about that paper. Please, Professor, if you would, give us a little background on that paper. Thanks.
Yeah, I mean, I'm a dabbler. I have very little interest in staying on one topic in the long term. And in 2019, what attracted my attention to ESG was the fact that this establishment had bought in. Now, by the establishment, I'm talking about the CEOs of the largest companies. If you remember, the conference board in 2019 put out a statement about how companies should be run for all stakeholders. And by 2019, the world's largest investment fund manager, BlackRock, and Larry Fink in particular, had said ESG is the place to go. And I was surprised at how quickly the establishment had bought in, trillions of dollars behind it. And I said, what's there? I mean, I had no idea what was behind this push and why it had succeeded. So I decided to take a look at what it was in this concept that made it so attractive. And you know what? I found nothing. It was like trying to nail Jell-O to a wall. It was a concept of emptiness. And I have to be quite honest, for 3 years, I've tried to find something good to say about ESG, and I'm still trying. So what drew my attention to it was just the enormous popularity of the topic and the fact that people were going around, ESG advocates were going around promising cake with no calories to everybody. What I mean by that is they were pitching ESG as being good and you could have high returns at the same time. So going to investors and saying, hey, you can invest in good companies and make higher returns at the same time. They were going to companies and saying, hey, you can be good and be more valuable at the same time. And that set my antenna quivering because the history of business is about trade-offs, which is there's always a cost when you tell me to do something. And the fact that they were selling it relentlessly as being good with no side cost struck me as false. I said, there must be something that they're missing here. And that's what led to what you saw as the paper, which really grew out of a blog post in 2019 that I wrote, that I've written 2 other posts on. And since I'm not required in my blog posts to be polite and academic, I can say exactly what's on my mind. So the 3 blog posts I have on ESG convey my views on ESG much more directly than the paper does. But that's what led me to ESG, is to take a look at what it was in the concept. And the more I looked, the less I saw there. The old Gertrude Stein description of Oakland, which is there's no there, is exactly the way I ended up after looking for years at ESG research. There's no there. I mean, the more I see it, the less substance there seems to be in the topic.
Understood. So if we could drill down a little bit sort of into the valuation aspects, the inclusions and the exclusions. You referred to, quote, the bad guys win. These are sort of the exclusions, what I'd call my orphans, sort of high expected return securities, as Cliff Asness had pointed out. I wondered if you could give us a little valuation aspect on the inclusions versus the exclusions, let's say.
No, I think that what I was drawing on was not valuation, but religion, because ESG was sold as a religious concept. there seemed to be an element of, hey, if you're good, you're going to be rewarded with heaven. It's very similar to how religion has marketed itself to people is goodness leads to heaven, badness leads to hell. So one of the pictures I drew was, hey, let's take the ESG sales pitch and let's visualize what heaven will look like. So this is your best case scenario for ESG. If you're a good company, you're able to grow your revenues faster. Why? Because more people buy your products. You earn higher profits. Why? Because you have lower costs, employees stay on with lower salaries. You're less risky. So in other words, your benefits from ESG show up as higher revenues, higher cash flows, higher profits, lower risk, and a higher value. That's a goodness wins. You go to heaven. There's a very direct opposite view of ESG, which is, hey, we live in a world, and this is a cynical view, where the bad guys often win. And in that world, here's what happens. Being bad actually benefits you. You're bad, you're able to undercut your competition, you're able to sell more, earn higher profits. You might be able to fool investors and banks into lending you or investing money at your lower rate. So I said, up front, I don't know which one is the right description of the world. Maybe goodness wins, or maybe badness wins, or maybe this is nuanced, where for some companies, goodness can benefit you in terms of higher growth and higher profits, and some companies, badness benefits you, and there's no one size fits all. Now, my priors in valuation tells me that no one size fits all, that we live in a world of nuance, where for some companies being good can be good for them, and for some companies being bad can be good for them. And there's no way ex ante you can tell me that one is always going to dominate the other. So that vision of goodness, badness, and how it pays off in valuation cuts to the heart, if you're a business, as to whether you should adopt ESG. You're a CEO and you ask me, should I be good? I'm going to ask you, what kind of company do you have? What are your products and services? Who buys them? Because without knowing any of those, how can I answer that question? So I think this is a time, the answer to that question lies in looking at the business, looking at customers and asking, how will ESG play out in this company, not across all companies?
Okay, let's change directions a little bit while still on the subject of ESG, obviously. You've said in the past that some of the academics papers that have been published should never have seen the light of day. And you talk about ESG as sort of a money machine, too much money for fast change. And sort of you actually threw the acronym from SRI to ESG to RIP was sort of your hope, is what you said. Where do you see things going? How do you describe it currently? And where do you see ESG going as it exists today?
This is not just directed at ESG. There's a rule in statistics that if you start off with significant biases, the data will bend to give you whatever conclusion you wanted to find in the first place. One of the problems with ESG research is most of the researchers, not all of them, working in this area are ESG advocates. They believe in it. They believe in it not because of the data. They believe in it because they think it's the right thing to do. They're driving it based on the belief that this is what the world should be doing. Now I'm going to do research to see if it works. And guess what? If you start off with the presumption that this is how the world should work, your research is going to come to that conclusion. So my point is 80 to 85% of this research is unbelievable because there's too much bias up front. And anybody who's stayed in this area, who's done multiple papers, is lost his way or her way. Because you do 10 papers in ESG, you're way too deep here. Not only are you biased because you think ESG is good, you've built a career around ESG. Now, how the heck do you walk away from it and say there's nothing there? You preempted that option. So when you look at the research and you wonder why it's so bad, and it is really bad in terms of following statistical rules, checking for things like causality, which direction the causality runs, things you're taught in a base statistics class, forget about a PhD. So why are they not asking this question? The answer lies in the fact that I remember the old Jack Nicholson movie where he plays in some movie where he's a general in the army and he's in court and he says, you don't want to know the truth. when he's asked, and I think in a sense, a lot of ESG researchers don't want to know the truth. They want to get data findings that back up their presumptions or preconceptions about ESG. And unfortunately, when you do that, your research becomes pointless and worthless.
Yeah, I think that's the "you can't handle the truth" episode, right? The incident, right? Yeah. And it seems like a lot of the folks are digging in their heels now. And I would say that the industry is so big that it pays for them to really not handle that truth, apparently, is what I think we could say.
It's not even that they're digging in their heels. They're essentially saying, this is not the ESG I'm thinking of. It's actually a very convenient place to be if you're an ESG advocate. Anything that comes out against ESG, you argue it's because somebody somewhere else is doing ESG incorrectly. So one thing that I've seen from ESG advocates is that, hey, this is a problem with the services. Take it up with Sustainalytics, S&P. They're getting this wrong, but my definition of ESG is purer. It's a better one. And if the world ran based on that definition, then ESG would work. It's like the defense of socialism, right, that you've heard, which is the reason socialism hasn't worked, I hear from advocates, is not because it doesn't work, because the way in which it's been tried is incorrect. That if it was done the right way, it would have worked. The problem there is, how do you dispel that notion? Because the argument is always going to keep moving on you, because whenever you critique what somebody is doing, you say, hey, that's not my definition. In fact, last time I was in a debate with an ESG advocate. Now, she said, well, what's your definition of ESG? I said, I don't have to give you a definition of ESG. I'm not the one selling it to people and making hundreds of millions of dollars. The obligation is on you to define ESG, not for me to give my definition of ESG so you can pick it apart. And so maybe the first thing that ESG advocates need to do is get together in a gigantic conference. They can do whatever they want, fly in jets to get there, create climate change to get there, and come to a consensus among themselves about what exactly they're measuring with ESG. Because there seems to be no consensus there. What I hear from Sustainalytics about what their measure of ESG is and what they're trying to measure is very different than what I hear from ESG professors at Harvard and what they're trying to measure.
It's a bit of the true Scotsman fallacy, right? And I think, I read in some of your research, and mine did the same, that you could find 3 or 4 different E, S, or G ratings dependent on who was giving that rating score, if you will. So I want to get on one little topic here before we wrap it up. I want to talk a little here about risks. And I see that, we talk about sort of the capture of some of the rating agencies by Wall Street. We've seen this before, the global financial crisis, the CDOs and how things were rated. And I wanted to just get your view on sort of the herding mentality, if you will, that ESG has caused into certain areas versus sort of the exclusion. Again, this is a little bit more on the inclusions and exclusions, but are you seeing some of the potential heightened risks we've seen around the globe lately is, starving energy and fossil fuel, nuclear energy and fossil fuel in the ESG move? Do you think that's sort of heightening some of the imbalances, let's call them, around the world?
I mean, it's not just in financial markets. This is a collective fantasy we've had for the last 20 years that somehow we can solve our energy problem and our climate change problem by relying on wind and solar and hydro. And that was never going to fly. There isn't, I have solar panels on my house. I'm a great fan of solar, but I live in California. I live in San Diego. The sun shines all the time. You can't have solar panels in Maine and expect to collect enough energy to keep the state going through even a minor crisis. And even in California, you can have every house have solar panels, but we won't have enough energy to cover our needs. So it's not just in financial markets, but in politics, we've nurtured this fantasy that somehow we can make fossil fuels and the companies that produce them into evil personalities, push them to the side, and manage our energy problem. If nothing else, the Russian invasion of the Ukraine has revealed how how empty that promise is, because here's a statistic that ESG advocates need to explain away to me. 20 years ago, before ESG was even a glimmer in anybody's eye, this is before 2004 and the UN document that gave rise to ESG, we got about 82% of our energy from fossil fuels. After 20 years of being, ESG and, as well as all the political movements towards cleaner, you know how much of our energy we still get from fossil fuels? About 80%. So if we're doing all this amazing stuff, convincing investors and consumers and politicians that fossil fuels are terrible and green energy is the way to go, how do you explain away the fact that we're still so dependent? You know what we're doing? We're taking fossil fuels and we're saying, you make us uncomfortable. We're US investors, we're European investors, we're US politicians. You make us uncomfortable. We're going to push you behind the curtain and act like you're not there. Remember the famous Engine One, this activist group that managed to get Exxon Mobil to pull back on its fossil fuel reserves? Somebody should ask them what exactly they accomplished. Where did those reserves go? In the last decade, private equity and hedge funds have invested more than $1 trillion in fossil fuel reserves. You know what we've done? We've taken reserves out of the hands of the Royal Dutch and Exxon Mobils of the world, where we had a chance of influencing how they'd be developed, and we put them in the hands of some of the least scrupulous people on the face of the earth.
So essentially, the energy equation hasn't changed, just the visibility of that equation has changed.
Exactly. This is the doing good versus sounding good. We all go and pat ourselves on the back, tell ourselves how amazing we are because we put our money in ESG funds. We put the pressure on primarily European and US oil companies to not do much. Do you think Aramco feels any pressure from ESG advocates? I'm sure there's OPEC meeting this week and they were talking about ESG concerns. I don't think so. This is very selective pressure, and historically selective pressure doesn't work. It just moves the problem elsewhere, and that's exactly what we've done.
Well, that's awesome. That's really fantastic. I want to thank Professor Aswath Damodaran for joining us here today. Everyone, be sure to follow him. He is at Aswath Damodaran on Twitter. He has his blog, Musings on the Markets. And I want to let everyone know that his work obviously is available on his website, and his link is also on my ESGOrphans.com website under the Research tab. I want to thank everyone for tuning in, and be sure to tune in for episode 3, where we're going to talk about suitability of the ESG Orphans and how it may fit into some people's portfolios as a balancing act and smart risk reward in the future. Thanks again, Professor Damodaran. Really enjoyed having you. Thanks so much.
Thank you.